Fed Chair Jerome Powell says the time has come to cut rates, and they could eventually fall 200 basis points. The Kiwi dollar is rising against the Aussie despite a tightening of interest rate differentials. Japan is set to keep hiking, and inflation was below forecasts in Singapore. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Australia economist Maddie Dunk has taken a closer look at how an eventual fall in Australian interest rates might affect house prices differently in different capital cities.
I think that you're likely to see some of those more rate-sensitive capital cities. If I think about Sydney, that's a prime example, really benefiting from a cut in interest rates.
But first, in 5 and 5 with ANZ, the US dollar fell 0.8% and US stocks rose between 1 and 1.25% on Friday night as financial markets bedded in expectations the Fed will start cutting next month, most likely with a 25 basis point cut. That was after US Federal Reserve Chairman Jerome Powell gave a keenly awaited speech to his fellow central bankers at Jackson Hole on Friday night. He said the time had come to cut rates and that he wouldn't welcome a major cooling of the jobs market. But the key question is, how much will he start with and how much will there be in this cutting cycle? Here's ANZ Head of G3 Economics, Brian Martin, speaking from London over the weekend.
I think when Powell is saying, look, we don't want the labour market to cool much from current levels, it means he's saying we're not going to set policy in a way that's going to ensure the labour market weakens materially further from here. So it's now time to start dialing back, and I think they will do that. And as they say, we anticipate that they will cut rates by 200 basis points over this cycle, and we see the target for Fed funds 200 basis points lower in 12 months' time.
The Aussie dollar starts this morning at 67.92 US cents, up nearly 1.5% over the day. The Kiwi dollar up 1.6% at 62.32 US cents. Number 2. The next question for markets is, when does the cutting start and how quickly might it start? Brian says markets are sure there will be at least 25 basis points when the FOMC next decides on September the 18th. Market expectations are, though, that there's a 20% chance it could be a 50 basis point cut. Here's Brian on what might push the Fed one way or the other before September 18.
The Fed are going to have a very controlled view of this, and if the economy unfolds broadly in line with their expectations, which is one that anticipates a soft landing, not a hard landing in economic activity, then they probably will, as a baseline, proceed with gradual rate cuts in the region of 25 basis points. I think you would need to see significant economic weakness to encourage them to be cutting by 50 basis points, particularly given that inflation, although it has improved, still remains above target.
Number 3. The New Zealand dollar has strengthened nearly 2 cents against the Australian dollar to almost 92 Australian cents in the last week. That's despite the RBNZ cutting interest rates, while the RBA is on hold. Here's ANZ New Zealand's chief economist Sharon Zolder with a curious reason: the relationship between dairy product prices and iron ore prices.
We had a really good dairy auction this week. At the Global Dairy Trade auction, prices rose up 5.5% and over 7% for our single biggest export, whole milk powder. And that's at a time when the iron ore price is not doing so well. So essentially the price of each country's largest commodity export going in different directions at the moment.
Number 4. Japanese inflation data out on Friday was mixed, with the headline inflation rate up to 2.8% from 2.6% in June. But inflation, excluding food and energy, actually fell to 1.9%, and that was the first time under 2% since September 2022. Here's ANZ FX analyst Felix Ryan.
Overall, the July inflation report does suggest that inflationary pressures are developing in Japan, but they do not support an aggressive Bank of Japan tightening cycle. Rather, it highlights that the Bank of Japan will normalise policy such that they do away with excessively loose monetary conditions. The strongest signs of a rebound in private consumption and wage growth may also see service price pressures develop further from here.
Number 5. Data out on Friday showed Singapore's annual CPI inflation rate fell to 2.5% in July from 2.9% in June. Now, that was lower than expected. ANZ Head of Asia Research Kun Go says lower import prices, because of that strong Singaporean dollar, were a factor, along with lower airfares and holiday costs.
What this implies is that core inflation in Singapore is on track to continue to head towards 2% by the end of this year. Now, at this stage, I don't expect the MAS to adjust policy at their October MPS meeting, but if we get further downside surprises on the inflation front, I think we could be getting closer towards an easing from the MAS.
Good go there. Now, in our bonus deep dive interview, ANZ Australian economist Maddie Dunk has taken a closer look at how an eventual fall in interest rates might affect house prices differently in the different capital cities. She's talking here with my colleague Alex Tarrant.
So we're seeing in Perth that we're expecting housing prices to be up around 25% this year. Similarly, Brisbane and Adelaide, we're expecting 15% growth. So we've lifted our forecast there. But then if I think about Melbourne, we're expecting a bit of a slowdown there. So over 2024 so far, we've seen that Melbourne housing prices have been moving backwards, and we expect that housing prices in Melbourne are going to fall 1.7% this year.
Are there different reasons for why the strong states are going to get stronger and the weak states continue to be weak? Because is it due to underlying employment growth or underlying economic confidence in these states?
I think ultimately it comes down to the supply-demand imbalances that we're seeing across the capital cities. So in places like Perth, for example, we are seeing that there's just not enough properties to meet demand at the moment. It's a similar story in Adelaide and Brisbane. On Brisbane, we've seen very strong housing price growth there over the last couple of years now, and we actually expect a little bit of a slowdown from the current pace by the end of the year, and we are seeing that some of those more expensive properties are finding it a bit more challenging at the moment in Brisbane. So a modest cool down there, but still up 15%, so very strong. And then alternatively, if I look at places like New South Wales, look at Melbourne, look at Hobart, what we're seeing is that particularly in Melbourne and Hobart, there are more properties than people that are wanting to buy properties at the moment. And auction clearance rates in Melbourne and in Sydney have started to soften recently, so that should flow through into that softening in prices.
And then you've also looked at where you expect housing credit to go. How closely is that tied in with house price growth in those capitals?
Look, housing price growth is a big driver of what's going to happen with housing credit, no doubt. Now, I think the fact that we are expecting this continual growth in housing prices, it should support housing credit over the near term. And we are expecting, if you think about the bigger picture for housing prices, that we are going to see reasonably robust growth going forward. So we're expecting 5.5% in 2025, around the same in 2026.
And just looking ahead to potential drops in interest rates in Australia, is it a matter of just holding on until we get to interest rate cuts for the building sector and the construction sector in terms of those dwelling consents maybe picking up?
I think that you're likely to see some of those more rate-sensitive capital cities. If I think about Sydney, that's a prime example, really benefiting from a cut in interest rates. Really, we've probably been surprised at the fact that the rapid increase in the cash rate and the flow-on effect that has had on borrowing capacity hasn't flowed through to the housing market and housing prices as much as we were previously anticipating.
And then on the other side, you've got a worsening labour market, which might put a bit of downward pressure on things.
If I think about the impacts of the labour market, we often talk about recessions. People don't feel a recession through the GDP numbers. They feel a recession through what's happening in the labour market, whether money is still coming in, whether they can pay their bills. And it's a similar thing with housing prices. If people are becoming more anxious about what's going to happen with their jobs, it is likely that they're not going to make those big purchases and consider upgrading their property, for example. So there are risks on either side, and people at the moment are managing those higher, more elevated rates well. We can see in data from the RBA, for example, most people on variable rate mortgages are managing to keep up with their repayments. Those people who aren't have strong savings buffers that they can draw on. But if people start to lose their job, then that really changes the dynamics there, and it would have a big impact on what happens with housing prices.
Maddie Dunk there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, August the 26th. Catch you tomorrow with a look ahead to key Australian inflation figures due on Wednesday. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.